You can choose to participate as solo trader in the trading challenge. Alternatively, you may choose to team play. Despite the main prizes, we also have rush hour surprise every 3 times a week to spice your day. The challenge starts yesterday and we have our first rush hour mission. Second rush hour mission is right up. You still have a chance to join us today as the registration remain open throughout the challenge. We are excited to invite David Ng as our speaker, as he is a full-time proprietary trader with IcebergX and he is about to share his experiences over his career. Now let's start with the Trading Challenge webinar series to help you win. You can choose to participate as solo trader in the trading challenge. Alternatively, you may choose to team play. Despite the main prizes, we also have rush hour surprise every 3 times a week to spice your day. The challenge starts yesterday and we have our first rush hour mission. Second rush hour mission is right up. You still have a chance to join us today as the registration remain open throughout the challenge. We are excited to invite David Ng as our speaker, as he is a full-time proprietary trader with IcebergX and he is about to share his experiences over his career. Now let's start with the Trading Challenge webinar series to help you win. You can choose to participate as solo trader in the trading challenge. Alternatively, you may choose to team play. Despite the main prizes, we also have rush hour surprise every 3 times a week to spice your day. The challenge starts yesterday and we have our first rush hour mission. Second rush hour mission is right up. You still have a chance to join us today as the registration remain open throughout the challenge. We are excited to invite David Ng as our speaker, as he is a full-time proprietary trader with IcebergX and he is about to share his experiences over his career. Now let's start with the Trading Challenge webinar series to help you win. You can choose to participate as solo trader in the trading challenge. Alternatively, you may choose to team play. Despite the main prizes, we also have rush hour surprise every 3 times a week to spice your day. The challenge starts yesterday and we have our first rush hour mission. Second rush hour mission is right up. You still have a chance to join us today as the registration remain open throughout the challenge. We are excited to invite David Ng as our speaker, as he is a
Hello, welcome. Hi, David. Are you here
Yep.
on the
Okay.
line?
Yep.
Okay, let me check. Okay. So I'll start with the brief introduction first, and then we will introduce our speaker today. Yeah. So
Sure.
okay. Right. Hello. Good evening, everyone, and welcome to the day 3 of our Trading Challenge webinar series. I'm Sulin, your host today, and I'm excited to have you all here today. For those just joining us, the registration for IcebergX Derivative Trading Challenge is still open, and it's running until 16 June 2025. So we have about 1 month plus to go, the registration, and the trading is already start on this Monday. Okay, so if you haven't signed up yet, now is the time. Okay, so to participate in the trading challenge, here what you need to do. First of all, you have to open a derivative trading account with IcebergX Sdn Bhd, and then secondly, fund your account with 100 ringgit for the registration fee. And then third, you can enjoy the benefits such as access to our trader community, to interact with others and discuss the market. And secondly, join our webinar series. We have a recorded version, we have live versions to learn about futures trading. And also you can get a 1 hour one-on-one coaching sessions if you need personalized guidance. So don't miss out. Register now, fund your account and get started. The challenge has just already begun, and we are here to support you every step of the way. Let's make this an exciting and educational experience together. I look forward to seeing you all in the community. Okay, so now let's move on to the exciting part. Let me move my slide. Right, day 3. The title of this today webinar is Trading Strategy and Opportunities in Malaysian Futures Market by Mr. David Ng. So before we start, just some heads up. The information sharing today is purely for educational purpose. There's no buying, selling advice. So if just assess your risk tolerance and consult with a professional before you do any trading decisions. Right. Okay, now coming to the excited part of tonight's sessions, let me introduce our speaker for tonight's sessions, Mr. David Ng. David is a full-time proprietary trader with IcebergX Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. With extensive research experience, David is highly skilled in trading commodities and indices, particularly the Malaysia Index and crude palm oil futures, which is FCPO. Prior to this, he led a young and dynamic team at a well-known local brokerage, promoting futures and derivatives to the Malaysian public. Many of you might also know him from his regular seminars and market coaching sessions, where he helped numerous individuals kickstart their trading journey. He is also a familiar name in the media, regularly sharing market insights with The Star, Business Time, and The Age. David graduates from University of Manchester with a degree in economics and business study, and he holds a chartered market technician's CMT designations. Let's welcome Mr. David Ng as he shares with us some practical trading strategy for navigating today's markets. And David, are you ready?
Yep.
Okay, so I will stop sharing from my side.
Okay.
Oh, your turn.
Yeah.
Alright.
So I'm just going to share my screen. Just let me know if you can see my slides.
Okay, try to.
Now. Yep. Are you able to see the slides?
Yes. Yes, I can see.
Okay. Yeah. Thank you, Suling, for the very kind introduction. And just before I start, just like to thank Apex Securities as well as Bursa Malaysia for inviting me to speak on today's topic, trading strategies and opportunities in the Malaysia futures market. So hopefully, at the end of an hour session, you're able to gain some insights on how to kickstart your trading journey, especially with the trading challenge that's organized by Apex. Now hopefully you can gain some technical skills that you're able to navigate the market, be it whether if you talk about futures market in Malaysia, the two major products are mainly the FKY and FCPO market. So hopefully at the end of the session, you're able to gain a bit of understanding on how to use certain tools to pinpoint certain entry and exit strategies accordingly. And obviously markets nowadays are very volatile. It gives a lot of opportunity. Once markets are more volatile, there's always opportunity that's present, and it depends on how we're going to navigate the market, especially during volatile periods, and how we can capitalize on those opportunities. So as usual, I think just to put it up again and to reiterate what Sulan just mentioned, I think the presentation today is purely for educational purpose. So any opinion that I give is purely based on my personal opinion, doesn't reflect any opinion from either it's from Apex or whether it's from Bursa Malaysia Exchange. So do keep that in mind. And I just want to reiterate the point that Sulen just made, is that if you are new to the futures market, futures itself is a derivative instrument, so make sure you are gain sufficient knowledge before you embark on a journey into the futures trading. So make sure you get advice from licensed representative, and I think definitely the futures market does involve risk, so make sure you're well accustomed and acknowledge those risks accordingly. So this agenda, I think the next 45 or an hour or so is what we're going to cover. I think firstly is to look at, if you talk about the two key products under Bursa Malaysia, which is the FKY and FCPO, it's important for us to look at some of the fundamental factors that actually affect prices. I think it's very tedious. I usually get this a lot. It's very tedious for traders who are new to the market to really understand fundamental factors that drives prices. But it's important because sometimes we especially we trade commodities like FCPO, which is very cyclical in nature. Sometimes we need to understand why the price directions behave in such a way. And most times and most often, it usually relates back to the fundamentals that underpins that kind of price movement. So it's important for us to get a mix of both fundamentals and also certain technical strategies that help you to navigate certain entry and exit strategies. Now, I think on the second part of this webinar, I'm probably going to be cover on certain technical strategies that you can utilize, especially looking at trends. Now, markets are definitely volatile. Obviously, there's also pocket where or periods of time where markets does display certain trend tendencies. So when that happens, when trend does appear in the market, we do have the tools, the necessary technical tools that we are able to use and utilize, especially in those situations. So I'm just going to share what are the technical tools that you can use, especially when you want to look at markets like FCQ and FKI. And importantly, if you are new to the futures market, in every decisions that you make, or in every trading decisions that you make, you must have a plan. Whether it's a plan to enter, and most important is a plan to get out. It is never. Sometimes we tend to often disregard, or we put emphasis on getting most of the time getting our decisions right. But markets are very volatile, and the nature of the market is that markets are dynamic. So it doesn't mean that your plan works this time round. It can work all the time. Sometimes the market dynamics change and requires you to assess again your trading plan and to readjust certain parameters in order to navigate those markets. So it's important. It's not about a profit at the end of the day. It's really a matter of how you manage your risk and loss at the end of the session. So importantly, you must have a plan especially if you are new to the market itself. You must have a plan to get in and get out. Now, I just want to give you a brief highlight on where things are looking at. So if you just look at sentiment-wise, I think market generally is, whether you talk about equities, commodities in general, I think everyone is got shaken by the initiation of the Trump tariff. Now, I think this has created a lot of chaos and volatility in the market. And therefore, I think if you just look at where sentiments are, and at this point in time, I think generally, markets are expecting that in the next 6 months or so, things may not look so bright. We started off January this year looking very optimistic for 2025, but I think things start to change when inauguration of Trump and Trump initiated the US tariff against majority of the country in the world. So I think that created a lot of uncertainty and chaos in the market. So generally, I think sentiment is in the next 6 months or so looks quite. If you just look at where IMF projected, I think world economy is probably going to slow down quite dramatically if the tariff is being implemented and is going to stay for quite some time. So do prepare. I think when global economy is heading to down south or heading to softer tone, generally expect equities and commodities generally don't do well. So that's the picture that we are getting. And I think watch out in the next 6 months is going to get a lot of volatility. I think with Trump being an unusual factor and it's a volatile factor, we have to keep that in mind. So if you are trading a market, you really have to be watchful on what Trump is going to do, especially with regards to tariff. Now, I just want to highlight this point. I think if you just look at it, US market, just because US market is generally the titan of the global economy. So if US starts to slow, I think majority of the world economy will start to slow as well. You can clearly see although equities in US market has actually rebounded from the all-time low, the recent low. But then again, you can see that momentum is still lacking behind. With uncertainty with tariff that's going on, it's going to be something that's going to pressure sentiment. And unfortunately, I think with yields that's also rising, it's giving a lot of pressure when it comes to inflationary pressure that's in the market. So US market is going to be very volatile, and it's going to affect a lot of other market in that space. Now, if you are trading the FKI, you do notice that the FKI and the Dow Jones market are actually quite parallel. They move quite in line. So obviously, the weakness in US market will translate into weakness in our own market as well. So I think this is an interesting chart. It shows you that US equity is dominated by foreign ownership, treasury-wise as well. So I think majority of the big holders are mainly Japan and China. So if these two countries starts to downplay the importance of US equities and US treasury, I think that's going to be a big issue. That means these two countries will start dropping off US assets in the market, and that will create a lot of pressure for US denominated assets. So I think this is going to be interesting assets, or rather it's the market to watch. But having said that, this only just create uncertainty that's going beyond. So, whether you are in the equity space, whether you are in the future space, you do watch out. I think definitely this is going to spell out more volatility that's going to see going forward. Now, US and China tariff is very intense. Obviously, recent days we have seen that there's signs of abating, but I think as long as Trump is insisting on putting high pressure, high tariff measures on China, and China is reciprocate, tit for tat. Really, it's going to be a intense fight between these two large countries. So let's wait to see. But I think effect is going to start to kick in, and I think generally the market will also behave. If you just look at where crude oil is, crude oil prices is fall below 60 on the WTI. It's showing you weaknesses across the board. And generally that doesn't spell good for the global economy. So if you are trading CPO, you are trading FKLI, you must have a view that in the next 6 months things are not looking so pleasant at the moment. Now, I think another theme that's worth to watch besides tariff is inflation. Now, generally, despite oil prices actually been coming down, but if you look at vegetable oil prices, now vegetable oil is a very big complex. It's not only talking about palm oil, you're talking about soybean oil, sunflower oil, rapeseed. Generally, I think vegetable oil, those prices are actually on the rise, especially bean oil. Now, there's a couple of factors why that drive the positive factors in bean oil prices, but I think that's not the main discussion for tonight. But importantly, you can see that vegetable oil as a whole is actually rising in terms of prices, and this will create a lot of inflationary environment. Not only vegetable oil, you can see other, whether it's grains or other commodities, it's also rising. So this creates a lot of inflationary pressure, and eventually that will also translate into how US is going to behave with their interest rates. And US interest rate is a big decision by FOMC. And I think that will also create a volatility with with overall markets as well, whether it's commodities or equities in general. So moving to FCPO fundamentals. Now, if you are new to FCPO market, palm oil futures on Bursa Malaysia is a very heavy liquid contract. You're talking on in excess of about 40 to 50,000 average daily volume on the active contract itself only. So that's a very liquid market. And generally, I think there's a lot of participation from be it whether people for using the futures market to hedge or whether you are using the futures market to speculate. There's wide across participation across different market members. So palm oil itself is very dominant, but I just want to share with you the historical perspective of palm oil. I think palm oil, back in the early 1990s, palm oil is not being favored as a much consumed vegetable oil in that space. But over the decades, we have seen the prominence of palm oil being very sustainable, and obviously, it is as population grows, it is the answer to feed those demand. And I think palm oil contribution to pretty much the oil and seeds composition in the world is actually gaining. We started off with only 15% of market share back in the early 1990s, and now we are almost 30% to 35% of the total global market share. So palm oil itself is actually very dominant. So if you are trading palm oil, you must understand Malaysia is in a sweet spot. It's a very important commodity for Malaysia in general. Now, these are some of the factors that affect CPO prices. Now, in any commodities, whether it's not only on palm oil, you talk about bean oil, beans, grains, or whichever, even gold to a certain extent. Commodities in general are always constrained to demand and supply. So basic economics, if you have strong demand and if you have weak supply, that tells prices will have to climb higher to reflect the increase in demand and the lower supply. Now, vice versa, if you have a situation where there is high supply and low demand, prices will have to come down to adjust the dynamics. So demand and supply is an important factor that drive commodity prices, and in this regard, also in the CPO market. Now, besides demand and supply, palm oil, which is a byproduct of palm oil, and is heavily traded in the Dalian exchange in China, China is also one of the largest palm oil consumers in the world. So they have a lot of relevance because of a byproduct. Palm oil prices sometimes could also drive CPO prices as well, and it's an interrelated relationship. That means CPO also can drive palm oil prices, and also the close substitute of palm oil, which is soybean oil prices, which is also an important element that also affect CPO prices as well. Now, crude oil prices also is another important element. Why is this important? Because CPO or palm oil is being used in biofuel. So if the price of crude oil is low, there's no incentive for biofuel producers to produce biofuel because oil price is still cheap. Now, if oil price is high, say for example, when we see those last 2 years, when we see WTI above $100, that's a lot of incentive for biofuel producers to produce biofuel using palm oil. So therefore, it will actually drive the demand for palm oil and push palm oil prices higher. So crude oil price is an important element for CPO prices as well. Now, whether it is something that is, it is unpredictable, it is having a big impact on commodities because weather can affect supply. And once weather comes into play, whether it's a dry weather condition, whether it's a flood situation, as we've seen last year, because of the massive flood that we've seen in the West Malaysia, in Johor and Pahang, you can see that that translates to higher prices or price rally at least 10% across the board. So weather is important play, but this element is very unpredictable. Weather can come in and disrupt production pattern, and that will cause rally prices. Now, ringgit strength is also another important element, and recently we can see that ringgit has strengthened quite significantly, and that pushes actually CPO prices even lower, because when you have strong ringgit, that means a lot of consumers, that's foreign consumers, that's actually buying because CPO is priced in ringgit, and because of the ringgit strength, they actually get less for the buck. So that means it really goes to show that stronger ringgit is usually favors or usually means lesser demand, and that will means lower CPO prices. So that's how ringgit relationship works with the CPO prices. Now, being in CPO space as well, and commodity as a whole, I think one good thing about trading the futures market in Malaysia, the CPO futures market in Malaysia, is because we have consistent and very timely reports, and these reports are crucial because these reports will tell you whether the demand and supply situation for the particular month. So are we in excess of demand or are we in excess of supply? So MPOB is a crucial report. It comes out every 10th of the month. It does indicate to you what are stock levels, the production levels, and the demand for the particular commodity. And besides that, you also have cargo survey reports, which comes out every subsequent 5 days sequence. It starts with 5, 10, 15, 20th, and towards the end of the month. So that will tell you, how the exports actually be performing. Now, these reports and estimates are crucial because generally, when you can gauge that, and you come into a situation in the market where there's supply is rising but exports are weak, you generally will expect prices tend to be lower. So vice versa. So SPOMA and MPOB are production estimates. They also come out on certain dates, and that will help you to gauge where the overall production or likely production for the particular month. So if you are expecting a high production month for the particular period, generally you will see prices being pressured as well. So obviously, MPOB is a key report, and usually we have Bloomberg and Reuters, which is the two major, data providers. They do have their own estimates, which gather from different sources, and they do publish before the official MPOB report is out. So so once MPOB report is out, you usually be compared against the estimates to see whether is it above consensus or below consensus. Now, these are all both prices, because usually market expects certain things, and if the actual report comes up to be better or worse, then price will have to adjust. So it's crucial if you are trading the CPO market to understand that all these reports are important, and it does affect prices in general. So just to share with you some example, this is the Bloomberg and Reuters poll, which is out on the 5th of every month. Just 5 days before the official MPOB report, you can see that generally when these surveys are out, market will probably be adjusting towards it. So we are expecting the April MPOB report to be very bearish, given the fact that production is rising, seasonality, and stock levels are starting to rise. Once you see stock levels are rising, exports are, despite it's also higher, but it's not enough to absorb the rise in supply, and that means we have an excess supply situation, and that will generally push prices lower. So we've seen past couple of days, if you've been watching the market, CPO really is being under pressure, just because of concern of a rising supply and rising stock levels in the country. Now, so we also have cargo surveys report like ITS or SGS or MSPEC. So they give you an estimate on where the CPU demand is coming from, or even demand figures for the particular month. So that will usually be compared against the official MPOB report. So all these estimates and reports are crucial for you to probably be expecting where the market is trying to paint a picture. Is it trying to paint a picture of concern that excess supply, or is it trying to paint a picture of excess demand? So I think these estimates and reports are crucial in that aspect. Now, I think one thing that is quite common when you trade CPU as a commodity is that it has seasonal tendencies. Now, what I mean by seasonal tendencies, now if you just look at this production data that's coming out from MPOB and you compare that for over a decade or 2 decades or so, and this is on monthly basis, you can see that very clear and very evidently that production starts to rise after the March-April calendar month onwards. So right now we are approaching May, which is the month where January the productivity of palm oil is rising, or rather the production of palm oil is rising, and usually the production of palm oil tends to peak around October, November. So that's where you can start to see production starts to come down, and usually you see stronger prices by then. So right now we are almost in a high cyclical period for the production aspect. So generally we expect prices tend to be pressured by the rising production. Now, despite that, I think over the past 3 or 4 years, we can see that production trend, whether it's Malaysia or Indonesia, both countries are showing a declining phase. Despite we have there's seasonal in play, but overall production is still in the decline, and that's concerning because consumption is not coming down. In fact, I think as world population grows, generally you expect consumption to increase year in year out, but production is not increasing, and that's generally going to be a concern because if consumption is rising across the decade, but production is not fast enough to capture that increase, it's going to mean that we're going to have low stock levels to bring or to carry forward to the next year, and that means prices will tend to stay strong. So I think overall picture, this is what we are getting. Now, if you just look at the palm oil yields across whether it's Malaysia or Indonesia over the years, it's actually been declining, and that brings to the fact that I think trees in the H3 profile in both Malaysia and Indonesia is slightly on the peak side. That means I think Malaysia is getting more severe, which means all the trees or the average age trees in Malaysia generally are talking about easily between 20 to 25 years, and that's usually mean trees are getting old and they can't produce as much, and that will bring your overall production on a lower end. So it's crucial. I think what this tells you is that Malaysia is in critical juncture to actually replant. If they don't do much replanting exercise in the next couple of years, that means it's really going to be pressuring yields going forward. Now, stock levels are also an important element to watch out for CPO market. Now, the key level is 2 million. Normally, if you notice that once Malaysia stock levels goes above 2 million, it's telling you the market is actually quite oversupplied. If it stays below 2 million, it's telling you that the stock levels are generally quite tight. And I think once you go below 1.6, 1.5 million tons, that's where I think alarm bells will start to ring. I think price will have to adjust on the upside because stock levels are very tight. So we've seen that situation in early parts of January and February this year, but I think things are going to start to change because supply is coming back, production in Malaysia is coming back. I think that generally will mean higher stock levels in months to come. So if you compare with CPO prices, high stock levels generally means lower prices, and low stock levels generally means high CPO prices. So you've seen that relationship, and currently I think if you're expecting the CPO stocks to rise, I think that's going to be pressuring CPO prices moving forward. Now, if you look at in terms of monthly trends, again, you can clearly see that stock levels tend to rise after the April and May onwards, right until the peak in production, which is usually October and November. So it's actually quite in line. Once you start to see rising production, normally that also entails your stock levels to start to rise as well. And this is where the situation we are in. We are expecting, market is behaving in a sense that they are expecting that the production and stock levels are rising. And it's a seasonal period right now. So as long as those numbers are prone to the fact that what market expect, I think price will be under pressure by then. Now, in terms of export side, generally I think export so far, this calendar year seems to be a bit weak. There's a lot of headwinds. I think firstly is headwinds from the global economy. China and India, despite they are two largest, they are still being externally influenced by other markets as well. So with China as a large consumer, they are battling on their own domestic economy front, with sluggishness in property prices and whatnot. I think that also created a lesser demand for palm as a result. So generally, I think exports performance this year has not been so good. But generally, we expect that towards the second half, we should perform better given the seasonal impact as well. So I think these are the things that we tend to watch out for. But again, I think right now the major equation for the palm oil dynamics is more to supply rather than the demand factor. Now, talking about tariff, which is an important thing and it's important theme right now. What US has imposed a tariff on Malaysia, and I think generally, if you look at it, palm oil is not an exclusion. But if you just look at the impact on it, US market is generally a very small market for Malaysia palm. It's still mainly the India and China, which is the largest buyer for Malaysia palm. So having said that, the impact, even though it's minimal, but it could cause repercussion across the line. But I think it's not a sign of concern because generally I think the US market for Malaysia palm is still a very small market to begin with. Now, what is important to take note of is that besides you're looking at lower yields in terms of year-on-year basis, if you compare over the past couple of years, whether it's both Malaysia and Indonesia suffering from lower yields, there's also another concern is that the yield factor for other vegetable oil, especially bean oil or rapeseed, they actually been doing very well. Whether it's technology or whether there's more more precise agricultural farming that created the kind of higher yields. That means supply of other vegetable oil will be higher compared to palm, and eventually that may capture some of palm market share. Now this is more of a longer term picture, but it's important for us to acknowledge. I think medium to longer term story for palm is that we're going to have low production, and if we don't have fast enough replenishment rate to replenish those production, probably palm will lose its market share. Now, important data to also look at, or factor to look at, is stock levels in some of the key buying countries, especially India and China. Now, if these both countries have high stock levels in their respective pot, especially for stocks of palm oil, usually they don't need to buy so much of palm oil. So right now, you just look at it, for this year so far, we have seen both India and China actually been, their stock levels actually been quite elevated. So that tells you generally they don't need to buy so much of palm at this point in time. But hopefully going forward, especially if India's seasonal impact comes in, generally, they will start buying around just before ahead of the Diwali season. That generally will push demand for Malaysia palm. Hopefully that seasonality do kick in the second half of this year. Now looking for comparing palm oil with soybean oil, which is a close substitute to palm. You can clearly see, I think, prices between these two intercommodity has actually been trading from as high as $800 premium, which means bean oil trade as high as $800 more expensive compared to palm. I think in terms of the spread, it was the highest in record. To as low as I think just a couple of months back, bean oil was trading at a steep discount. I think it was trading almost $200 discount to palm. So in that situation, I think generally means palm oil is more expensive. Now we come to a situation whereby palm oil is relatively cheaper back again. Palm oil is relatively about 100 to 180 to $200 cheaper compared to soybean oil. So now, given that this kind of discount is coming back, you can start to see that going forward, probably India and China will probably look at the bean oil and palm oil spread and to assess whether palm oil is cheaper compared to bean oil. And if that's the case, you can start to see demand shifting away from bean oil and over back to palm. So this can be a positive factor that can contribute to stronger demand going forward. But as long as this premium stays, we probably will see palm oil prices start to adjust on the upside to indicate that there's greater demand coming from because of palm oil trading at a discount compared to bean oil. So if you are trading the palm oil market, do observe this palm oil to bean oil spread because it's important. It tells you how expensive palm oil is compared to its close substitute, which is the bean oil market. Now, if you compare crude oil and palm, you can see there's quite a close relationship. So again, why palm oil prices are being pressured lately is also because of low crude oil prices. And this is again mainly because of biofuel demand. And if it's low crude oil price environment, you don't need so much, or rather there's no incentive for producers to produce biofuel. So there's no demand, or rather there's lack of demand for using palm as a feedstock for biofuel. So it's important relationship. When you have low oil price environment, that doesn't benefit palm oil price in general. Now, so this is what I meant. Other vegetable oil, like soybean oil, rapeseed, and sunflower, are gaining more productivity, but except for palm oil is losing its productivity. So if this trend continues for the foreseeable future, you can start to see that the market percentage for palm oil in the global market will start to erode, and that's going to be a major concern down the road. But again, this is more of a long-term thing, but it's important to have that picture in perspective. Now, if you are trading the futures market, one thing good about trading futures is that you have many different contract months, many different forward contract months for you to look at, observe, and also trade. So if you plot those further month contracts, you plot those prices in a chart, you can see that market generally, for example, in the early part of April, we start to see that the markets in the near month contracts, especially those in nearest to the calendar month, those contracts trades as a very high prices compared to those contracts that's traded far ahead of the futures market, especially those that is 6 years or 6 months or even to a year forward. So why is this the case? So usually this happens is that when the current supply situation is tight, that usually push the near month contracts higher relatively to the far month contracts. So that usually we term those market as a backwardation market. Now things will change, and we see that clearly. I think just middle of April or early part or end part of April, we start to see that near month contract starts to drop dramatically. And I think right now, if you plot those prices in the current prices, you can see that generally the difference between the contract months, especially the near month contracts, are quite the difference are quite small. So it tells you that generally the curve is getting very flat. Now this usually happens when market dynamics change. So if you recall, I think early part of April, markets are very concerned about supply. Supply is not coming back. Stock levels are very low. There's a tight situation in the market. But in just 1.5 months, things has changed. Now the market is expecting that supply is coming back strongly, and I think stock levels will start to rise significantly. So therefore, you can start to see that the near month contracts are trading or rather the decline in the near month contracts is actually quite steep as compared to the further month contracts. So that gives you understanding this curve. Gives you or rather you can see the sentiment of the market. So I think going forward, this tells you that I think markets are expecting that fundamentals will turn bearish because of the rising supply and rising stock levels, and that means we should expect the market to trade in a contango market whereby the further month contracts will usually trade higher, and the near month contracts will be under pressure. So that do watch out. I think understanding this curve of forward prices will give you understanding, or at least you are able to gauge the sentiment of the market in a better manner. So that's on CPO. Demand and supply is a crucial factor. So I already explained to you some of the key factors to watch out, and especially when it comes to reports, or what are the dynamics that you need to look out for, and other factors that can affect CPO prices, especially bean oil and crude oil, which does come into effect, and that will probably have an impact on prices as well. Now moving into FKLI. Now FKLI is also another high volume traded product under the Bursa Malaysia, which is rated more into the Malaysia Index, equity index. So if you just look at it, the KLCI component stocks are only comprises of 30 major listed companies, and FKLI moves quite in line with the KLCI direction. Now if you just look at KLCI performance itself and you compare to other benchmark, be it whether you compare with the mid cap index or whether you compare with the small cap index, generally KLCI has actually been performing very well, and is holding very well throughout the whole period of this year. Whether the trend can continue, it all very depends on how the external market and also the domestic economy perform going forward. Now, this is where the interesting point is. If you just look at how the movement between the FKLI, against the Dow Jones market, you can see it's actually moving quite in line. So whenever there's strong performance on Dow Jones equity markets, you can probably expect KLCI to follow suit as well. But again, you can't use this as a basis of making decisions, because there's instances where these both markets can diverge. Now, before heading to 2025, if you have traded this relationship last year, you notice there's a lot of occasions where KLCI and Dow Jones doesn't really follow. In fact, you see a lot of strength in equity in Dow Jones market, but you don't see that kind of strength in the KLCI market. So there's divergence happening for our KLCI performance, especially it's quite evident last year. Now this year is slightly different. You start to see there's a lot of close relationship between both markets. So it's a basis point or a reference point for you to look at whenever you are trading the FKLI market. Now, Trump tariff, again, this is very dynamic. Things can change, and this will definitely be affecting markets across the board. So right now, I think US and China tariff war is very intense. While I think other countries, they're giving a breather. But let's see, I think that the breather is only about a month. So let's see what happens after a month. Although there's talks of negotiation in process and whatnot, but I think it's crucial, because tariff is a major trade war weapon, and if a persistent tariff is being imposed a long period of time, it can create a lot of negative repercussions. So I think Trump tariff is something that is creating chaos in the market. But like I said, whenever markets are volatile, there's always opportunity that's present, and it depends on how we manage our risk in those periods. Now, Malaysia as a whole is actually quite, I would say it's quite circulated, or rather, it's not so heavily impacted by the US tariff. I think the majority that is mainly affected is mainly China as being one of the largest. Followed by Mexico, and in Southeast Asia, I think Vietnam is one of the key countries as well that's actually heavily impacted by the US tariff. Malaysia on the whole, on the other hand, has actually much of a lesser impact. If you just look at palm oil, it's actually not much, because palm oil to the US states is actually very low in terms of composition. So Malaysia is actually well positioned in that sense. But again, Southeast Asia is a group of countries to watch out. As I think tariff war is actually getting intense, whether there will be a shift in interest away from China to Southeast Asia, that's also another story that we have to look at. Now, how is this going to be important is that, with this narrative that's in place, this is going to be something that, can propel the KLCM sentiment even further. And that's generally be something that benefits, especially the Southeast Asia countries. So again, to reiterate, I think in terms of impact, so far we have seen now on Malaysia is actually quite minimal. Even for palm oil as well, as I mentioned, the contribution for the US market is actually very small. And if you just look at it, majority of the electronic components are still being exempted. Now things can change. Whether there's a talks, or there's a possible implication that they may impose a tariff on those electronic items, then that is a different question altogether. But so far as of now, it's still pretty much status quo, and I think in that regards, it's still quite a minimal impact for Malaysia. Now, what is important, and whenever you look at the Malaysia market, is firstly is the ringgit strength. Obviously, you have seen how the ringgit strengthened in recent days, in recent weeks. Now, if you just look at it, the relationship between the ringgit strength and the FKI performance, whenever ringgit strengthens, you can start to see the equity market perform quite relatively well. Vice versa, when ringgit starts to weaken, you start to see generally the markets, tend to be weaker. Now, this is basically due to inflow and outflow of the foreign entities. So whenever they have more confidence, in the equity space, they'll be buying, or rather they'll be purchasing more ringgit in exchange for other currencies. That in a way, there's more inflow into the country's economy, and that will propel the KLCI higher. So ringgit relationship to KLCI, you can start to see that whenever ringgit strengthen, you tend to see KLCI perform actually relatively better compared to when ringgit weakens. You tend to see that generally the equity markets are also being affected as well. Now, this is interesting. You just look at being Malaysia, it's very commodity driven. Palm oil and crude oil is two major commodity element that is important for Malaysia. If you just look at it, generally we expect that crude oil prices will tend to affect the FKY performance. Now, in the past couple of years, yes, it does impact. Whenever you have low oil price environment, that generally will be pressuring the KLCI performance. But of late, you start to see that, despite the low oil price environment, you still see that Malaysia, the FKY performance are still pretty robust. So it tells you that there's a bit of divergence between the crude oil and FKY performance lately. So again, this tells you and shows you, you can't just trade on a basis of interrelationship between two products or two markets. Whatever happens in the past doesn't always translate into the future. So it's important for us, if we're trading a market, it's important for you to take note of this distinction. So whenever there's divergence happening, usually there is factors affecting certain particular markets that is not affecting the other market, and it's important for us to realize and acknowledge that when it happens. Now, foreign in-plays are important element for the Malaysia market as a whole. So if foreigners are buying or coming into the Malaysia market, generally you expect KLCI performance to be strong. But if foreigners are persistent seller, but there's a persistent outflow for foreigners in the Malaysia market, that usually tells you that the KLCI performance will tend to be weaker. So we have seen that. I think generally this year so far is still a net outflow for Malaysia. That's why KLCI performance has actually been very lackluster. And I think in early part of April we saw a massive, or whether there's a steep selling pressure coming from the foreign selling. So when that happens, that usually means there will be a lot of pressure for FLI performance. Now, not only that, if the foreign shareholders are declining, that generally means there's no inflow into the economy, or rather there's lack of confidence in the domestic economy. So therefore, that also translates into weaker index performance. Now, if foreigners starts to shift back to the Malaysia economy, or rather they start to come back to this region, then that's a different story. That will usually propel or support KLCI performance. So I think if you just look at foreign shareholding, actually been declining for many years now. If there's any sign that whether this will return is very much to do with whether Malaysia and this region as a whole, the Southeast Asia region, is able to capitalize on this Trump tariff, and as a result, I think foreigners will take that position. And obviously, interest rates also plays an important role. As long as US interest rate starts to depreciate further or decline, that will mean there's more incentive for foreign holders to seek other markets that actually give high interest, and in Malaysia could be one of the markets. So this is what I meant. I think global recession is quite imminent based on what we have seen so far, based on what we have heard, and especially the next 6 months is very crucial. If I think things looks down south, I think that will really pressure markets, and that will probably be something that I think Bank Negara will have to look at. Whether it's an interest rate cut imminent or not, that's really on the decision whether the external markets will be, the influence of external markets will be something that is something to weigh on the existing market. So really to watch, if interest rates were to cut, I think that could be a quick booster for the equity performance. But that generally tells you that when interest rates are cut, usually entails that there's a further or rather the economy projections going forward is going to be quite weak. Therefore, that propagates the need for interest rate cut. So if you just look at it, I think generally, this year there are a lot of different banks of various sources are expecting that interest rate cut for Malaysia is probably a single cut throughout the year. Now this can change. It depends on the situation in US. If US is aggressively cutting, then it's going to force other countries around the world as well to follow suit as well. So I think this is something that we have to watch out for. But generally, I think when you have an interest rate cut, generally be something that is it will provide a slight boost for the equities market. But in the longer run, it's a slightly different story, because usually rate cuts entails that the economy is probably going to get bigger, and that's why there's a need for a rate cut. Now, I just want to touch a bit of gold. Despite we also have a gold product on the Bursa Malaysia exchange, we have the FGLD. So if you want to have, you're keen to look at this product, do have a look at it. I think it gives you a very good exposure for the gold market. Now, gold is gaining a lot of popularity given the fact that the role of gold as a safe haven asset and against heightened volatility, heightened market volatility, gold usually tend to be favored. What's interesting is that I think Asia, the inflow into the gold ETF is actually quite massive. So it's telling you that the demand for gold coming from Asia is actually very strong, and it's actually mainly coming from China. So China, if you look at gold prices, why gold has been sustaining above the 3,000 US dollar per troy ounce is because China is massively buying for the past few quarters, and if they continue this trend, I think gold prices will tend to go even to higher levels, and 3,000 is actually a very strong support. Now, the key question to watch out is that China will one day. I mean, China is also a sensitive buyer, price sensitive buyer. If price rally too high, or they deem that the current price is just too high and they want to slow down their purchases, I think that will really pressure gold prices. So if you are trading gold, I think this is something that you have to watch out for, especially with the China factor. Now this is an interesting illustration on what everyone is doing. I think gold is something that is being favored right now because of the role of gold is as an asset that's against uncertainty and against market risk. So again, I think gold is the best performance asset class so far this year, and it will continue to do well. Given the fact that I think as long as market is volatile, the nature of market volatility that will propel gold, or that will actually generate interest for the gold market. So I think that's pretty much on some of the key factors and some of the fundamental factors that actually affect prices for both the power market and also the KLCI performance. So really, I think next is to look at how can we navigate the market using technical strategies. Now, if you are trading on a market using trend, there's a lot of trend tools that you can use. I think one of the commonly trend tool that people look at is using candles that's based on Fibonacci, which I'm going to elaborate later on. Then besides that, you can also incorporate moving averages, which is also another trend tool, commonly used trend tool. And I think another one is looking at DMI, which is an indicator that tells you generally how entails you or tells you how strong a particular trend is, or the strength of the trend. And last but not least, like I mentioned in the early part of the webinar, you must have a plan involved, and to do that, you must have a strategy for you to get out of the market in case the market go against you. And the way to do that is to look at certain ratios or certain range using the average true range or ATR for short, and from there we adjust your stop loss accordingly. So importantly, to look at trend is to first identify where the current trend is. If you plot two moving averages are a great simple tool for identifying whether the market is trending up or down. So as long as candles are trading below the long term and the medium term moving averages, is telling you that during the market is still on a downtrend. So this is what happens in the FCPO trend right now. You can see candles are clearly below both the 50 period and 200 period EMA lines. So it's telling you generally the CPU market is still on a downtrend market. Now, when you are doing a trend trading, I usually get this a lot. Is that people tend to always try to pinpoint reversal in a trend. It's never easy because market can trend for a long period of time. And pinpointing the exact reversal or the likely reversal point is never easy. So if the current trend is showing you a downside momentum or a downside downtrend, be in a position for you to find opportunities for you to short rather than long the market. So I think it's important to distinguish that, because a lot of people will say that since the market is already at this low point, must I just try to time where the market is likely to stop going down and time for potential reversal. It's a very difficult proposition to do that. So if the market is showing you a downtrend picture, in fact, it's better for you to identify opportunities for you to short rather than long, especially during a downtrend market. Now, FKLI on the other hand is still a downtrend market, but you can clearly see that despite the candles are below both the 50 and 200 period EMAs, you can see that the candles are trying to push the first major resistance at the 50 period EMA, which is about 1500. So 1500 is a very psychological level. If it does fall above that and it goes higher, there's a potential reversal in this FKLI trend. Again, it's all much depending on how the external market is doing, especially the Dow Jones market is doing, and obviously with the Trump tariff uncertainty. Now, obviously, if you want to understand why it's taken, actually just look at these two charts. These two charts points to you the same product, same time period. The only difference is the candles that's being used. So chart A is what is a normal Japanese candlesticks, which is available on most platforms. Now chart B is slightly different. Chart B is using a Heiken Ashi candles. So if you are looking at trends, you can probably chart B will be a better option because it does tells you, at this particular point in time whether the market is still on a downtrend or is still on an uptrend. Now if you use Heiken, if you use normal Japanese candlesticks, you tend to get a lot of whipsaws. The candles can be red and green subsequently, but Heiken Ashi, because it takes the average bar of a Japanese candlesticks, it does illustrates to you the particular trend in place. So as long as the candles are red, it's telling you the market is still a downtrend. If the candles are green, it's telling you that the market is still on an uptrend. Now the dynamics of it is simple for Heiken Ashi candles. As long as you see the candles are green, it's telling you the market is still on an uptrend. Now importantly is to look at the size of the candles, the width of the candles. If the candles are having a high width or long body candles, then this uptrend momentum is very strong. Vice versa, long red candles is telling you that this downtrend is very strong. Red candles usually points to you is a downtrend market. Now, if you start to see body of the candles are very small, almost like a doji, or almost like a cross or without body, that usually tells you that market is actually moving sideways. So if you're holding to a position, whether it's long or short, and you start to see the body of the candles getting smaller, and you start to see an appearance of especially during an uptrend, you start to see red candles appearing. That usually tells you that this uptrend momentum is going to lose out, so it's going to fade. So if you're holding long position, that would be a good time for you to get out of the market. These are the three major dynamics of using Heiken Ashi. As long as you see the color of green candle bar is telling you that market is on an uptrend. Red candle bar is telling you the market is on a downtrend. Now, having Heiken Ashi alone may not be sufficient. If you pair that with moving averages, you probably get a good signal in the sense that if the shorter term crosses below the longer term moving average is telling you that this is a bearish crossover, and if the candles, Heiken Ashi candles are red, that is a good signal to take. So for example, here we start to see there's a long red candle bar on Heiken Ashi, and you start to see that the shorter term moving averages crosses below, so you got a bearish crossover on the moving average. So this is a good point of entry for you to take a short position. Now vice versa, if you start to see appearance of green candles and the shorter term crosses above, that'd be a good signal for you to take a long position. So that tells you generally that it's a bullish crossover on moving averages. Now this is on FKLI is another example. So FKLI is actually more trending if you just look at longer term perspective, while CPO tends to there's certain period of time where markets are actually quite range. So obviously when markets are going sideways, you can't use Heiken Ashi or you can't use any trend trading tool. So here for example FKLI, you start to see appearance of red colored candle body bars, long red candle bars, and that tells you generally the market is coming on a downtrend. And if you pair that with moving averages, again, moving averages are also showing you a bearish crossover where the shorter term crosses below. So again, that reinforces that this market is likely is going to hit further downside. Same goes for here. The red Heiken Ashi candles, the body of these red Heiken Ashi candles are actually getting wider and bigger. So it's telling you that this downward momentum is actually getting strength. Now, I just want to introduce also a DMI indicator, a trend indicator. It stands for Directional Movement Index. Now, I don't want to complicate things because DMI has three different lines. We have what we call positive DI, minus DI, and the ADX. Now, if you compare your moving average crossover and your DMI indicator, the minus DI and the positive DI. Now, this DMI crossover works quite similar to a moving average crossover. How we do that is that if you look at this red line, it usually stands for negative DI. It stands for negative price momentum. So whenever it crosses above the green line, it's telling you that the market downside momentum is actually gaining is actually quite strong. But this signal is actually quite coincide with your moving average crossover, which is the bearish crossover here. So in a sense that the DMI and the moving average crossover are giving you very similar signals. But the crucial thing about using DMI is not for the crossovers; it's actually for the ADX line, the black line. So this ADX measures the strength of the trend. So here we identify the markets on a downtrend, and the ADX, the black line, is actually rising. So it's telling you that this downtrend is actually having strength. Same goes, as long as this ADX line starts to peak and starts to come down, it's telling you that this downtrend is losing its strength. So if you are holding a short position, once you see ADX starts to come down, it should be coming out of the market because it's telling you that this downside momentum is actually losing its strength. Oops. Sorry. Hopefully, am I still sharing? Okay. Okay. So if you start to see that ADX starts to rise, the black line here is telling you that the market momentum is too strong. So here is a good signal for you to take a long position because you start to see appearance of green candles and you start to see a bullish crossover and your ADX is rising. Now, the last indicator here is ATR, stands for average true range. Now this is important because that tells you how many what's the price range of that particular period of time. Now, once you have identified that, you put it all together. Once you identify the signals, the ATR is important for you to manage your risk accordingly. Now, how we do that? For example, if you got a long signal at 43.71, your ATR value is at 30. If you work on a risk to reward ratio 1 to 2, that means you're looking at 30 points of loss and 60 points of profit. As simple as that. But then again, the risk to reward ratio is actually depending on individuals. Certain individual may prefer a lower risk to reward. Certain individual prefer a higher risk to reward. But keep in mind, because if you are using ATR ratio, when the market gets very volatile, that means your ATR value will increase. So that means you are actually expecting a bigger buffer of loss eventually, because the markets are more volatile. You're preparing a bigger buffer. So do be mindful of that. If you can't absorb a heavy portion of loss, you have to adjust your ATR value accordingly. Now, just to show another example on FKLI, here's a very clear-cut example of the market possibly heading downtrend because the appearance of red candle Heiken SG bar is actually quite wide, the body. That tells you generally the market is weak. And most of the candles are trading below both the moving averages. It's telling you that generally the market or rather the moving averages is actually creating a lot of resistance for the market. Now, this is also crucial. The DMI, the minus DI, and the red line is actually trading above the positive DI, telling you that the market is on a negative momentum. But what is crucial to watch is the ADX value. As long as the ADX value is above 25, that means there's trend in place. So right now, this downtrend could be having a bigger momentum going forward. So do watch out, and the ATR value is at 4.5. So from there, you can actually create your profit target and stop loss level accordingly. So again, risk to reward ratio is 1 to 2. This is for illustration purpose. Some people may have a different risk to reward ratio altogether, but do what is comfortable for you. But keep in mind, ATR value will rise when markets are getting very volatile. So that means you have to prepare for a bigger bigger amount of loss accordingly. Okay, so looking at things where we are, I think for FKLI in January, I think the uptrend still remain intact. But I think January, if you look at the longer term, it's still January on a downtrend, but it's challenging if it holds above the 1500, the next level is challenging is 1550. It does break that. Generally, this FKLI market is turning from a downtrend to an uptrend market. Now, the key point to take note is that this black line, the ADX, is actually coming off. So it's telling you that this uptrend is actually losing momentum. So as long as we don't see any negative DI cross above, you still think that the market may consolidate for a while, and I think most likely the market is probably going to face a lot of pressure going forward. So I think the resistance are still there, but watch out, because I think this uptrend momentum is actually losing its strength. Now, CPO is the downtrend is still very fierce. It's telling you that the downside is actually still quite imminent, because the ADX is still above 25. And generally the candles are way below the 50 and 200 period EMA, and there's definitely a bearish crossover. So generally the CPO market is still on the downtrend, and the downtrend is still quite persistent. So any rebound is usually an opportunity for you to short the market. Now, gold on the other hand seems to be slightly on a stronger end. If you just look at the uptrend momentum, despite we are seeing a bit of retracement in the past couple of days and weeks, the ADX period is still rising above 25. It's telling you this uptrend there's still momentum to go higher. Now, obviously now is a period of consolidation, but I think once ADX starts to rise, and positive DIs holding well above the minus DI, there's still a bit of leg for gold to aim on a higher level. So I think gold, there's still a bit of strength on the upward momentum. Now, I think it's crucial to point out, if you are trading an FC4 market, we are in a seasonally weaker period. That's for sure. I think fundamentally, people are expecting that, or rather market is expecting that the production is going to be rising quite rapidly in the next couple of months, and stock levels are also rising in tandem. So prices will definitely be pressured by that. So I think, judging from where we look at, the key crucial level to watch out for CPO is to look at the key support level at 3650. I hope it does hold at that level. If it does break, that generally means that the market can still go even lower to test potentially the 3004 and the 3000 level. But now, keep in mind, I think the cost of producing CPO right now is actually getting higher and higher year on year. So generally, I think if you just look at anything that's below 3650, is actually putting a lot of cost pressure on a lot of producers. So there's a lot of pain points. So if a lot of producers starts to slow down on their harvesting cycle just because the price are not attractive, that generally also means weaker prices. That also means weaker production. That also be something that support prices. So keep that in mind. I think anything below 3650 will be a lot of pain points for a lot of palm oil producers, especially in Malaysia. Now, FKI remains, if you just look at the recent uptrend, the momentum of this recent uptrend seems to be waning, and that's also giving a lot of pressure. And again, I think US tariff is giving a lot of volatility for the market. As long as there's no clarity, there's no certainty on where US tariff is heading, that will put a lot of pressure for the FKI performance as well. So all in all, I think gold is the one that seems to benefit out of all this. And I think gold as an asset class has actually gained a lot of prominence this year because it broke a lot of records. So if you're trading the gold market, it's an interesting product to watch out for. And I think be mindful, as long as there's volatility and there's uncertainty in the market, gold tend to be favored in the longer run. So here are the contract specs. I don't go too detail. You can always get this information from a representative from Apex. I think they are more than happy to share with you. So do consult with them if you want to understand more of the respective product in terms of their features, and their respective contract specifications. So I'm just going to end with a quote. So if you are trading the markets, there is always there's a lot of sayings in the market. Now I'm just going to quote from a few great traders. I think Alexander Elder, if you have not known him, you can read some of his books and some of his quotes. I think he quoted it very well. I think the goal of a successful trader is, the most important thing is always to make the best trades. Once you have that frame in mind, money is always secondary. It's all about going to your processes and your plans accordingly. So like I mentioned earlier in the beginning, you always must establish your plan beforehand. And once you have that plan, you must be routinely and disciplined enough to stick to it accordingly. Now, I think Jack Swagger also put it very nicely. Amateurs always think about how much money they can make. but professional is always thinking about how much money they could lose. Like I mentioned, it's all about risk. It's never about the profit at the end of the day, because once you put that as a focus, most of the time you will put yourself unnecessary pressure. Now the third one, I think Martin Short's also is a very good quote. Learn to take losses. I think the most important thing in making money is not letting your losses get out of our hand. So again, to re-emphasize the point, I think if you want to be successful in trading in general, it's a matter of measuring your loss rather than measuring your profit. Once you get that right, your profit eventually will come. So with this, I'm just going to pause here, and I'm just going to hand it over to Suling for any questions that from the audience might have.
Yeah, and thank you, David, for the great sessions. Just think about 1 month ago, when Trump they started to impose the tariff thing. The market is moving every day like a seesaw. So maybe you would like to share a little bit about your secrets, how you overcome this emotionally, because the market, wow, one day 1,000 points, second day 500 points, 700 points. Yeah.
Okay, that's a good question. Now I think as a trader, part and parcel of our role is to manage market volatility, and not to say we like market volatility, but because market volatility presents a lot of opportunity. So like my case, for example, how do we manage is that the first thing, like regardless of what market conditions we are trading, we always have to look at the risk we are accustomed with. Obviously, markets are more volatile, so therefore, probably we need to look at positions. So just to give you an example, when markets are so volatile during the Trump tariff announcement, we tend not to hold any overnight positions, or we tend to hold shorter period positions, and we don't hold positions over the weekend, because you never know. Suddenly one announcement over the weekend can actually sway away your positions. So I think this kind of things that is crucial that we need to take note. So it all boils down to risk management. So as long as you get your risk management right, despite the market volatility, you're still able to thrive, because risk is a big thing. Once you control that, then eventually the rest of other elements are much easier to manage.
Okay, thank you, David. That one is actually my own question, because every day I
Sure.
see clients' equity ratio fly here and fly there. Wow. So you have to do a very tight risk monitoring on the positions and the equity. Alright,
No,
so
I mean for your role, you are looking from your client's equity, but from the client's perspective, it's more challenging, because they are the one making decisions. So if you are already feeling the pressure, they'll be feeling even worse.
correct.
So I think risk management is always the key. If you get it right, you don't have to stress yourself too much.
Yeah. Okay, thank you. Let's see the questions from the floor. Okay, got one. And David, what is your main trading technical indicators or analysis that you use to trade? If you're looking at the presentation, the sharing just now, the main, I think, is Heiken AHA. Can you share with us, like, you use this indicator for how long? Then only you started to master it.
Okay. Now the reason why I like to use Heiken actually, I got introduced this from my mentor. So when I first use it, I was finding this is just too simple. You can't. I don't think you can make good money out of it. But again, I think trading should keep it simple. The reason why I mean, to answer the question, is the main tool is Heiken actually, that's for sure. But also incorporating Heiken actually together with moving averages and the DMI. These three are actually very important. Working hand in hand. Now Heiken actually is for trend is an important tool, because it shows you how the market trends, or if you're holding a position, it keeps you longer in a particular trend, because the way it calculates, it takes the average of a candlestick bar. If you notice, Heiken actually represent the price gaps by the candle itself. So if you are using gap analysis, you can't use Heiken actually. You have to convert that to normal candlesticks. But again, I think Haken actually gives you a good point to look at trends. Now, if the just by the color of the candles, if the candles are green and red, it tells you generally where the market is likely to trend. So if you have look at, if you have understand how the market behaves, the price behavior, by looking at Haken actually long enough, you probably get a sense of where market can, where the formation of the next likely candle is. It comes with market experience, but I think Haken actually simplify the trend identification for you by the color of the candles and the dynamics of the candle itself. Now, obviously, Haken actually is important, but it's even more important to incorporate like moving averages and your DMI as part of the tool, which I really highlighted to you just now, because that gives you exactly where the potential your entry is and potential where your exit position is going to be, to have that combined, because you can't use Haken actually alone. You use Haken actually alone, sometimes you get a lot of whipsaws as well, because when markets are ranging, you can't use trend. I do see that a lot, or even if you go to shorter time frame, Haken actually will show you red, green, red, green. It's true, it's telling you the market is heading nowhere. But if you use it on a longer time frame, or when market is actually really trending, you start to see there's formation of subsequent series of candles. Then you can see clearly where the trend is going. And you pair that with moving averages and DMI, you actually get a pretty good entry and exit strategy.
All right. Further from the question just now, what is the time frame you recommend if I trade for daily only? And also the other one is if I trade, like I hold for 2 to 3 days, medium term.
Okay. Now, if you are looking on intraday basis, I would say 30 minutes is a good start, but anything below 30 minutes, like 15 minutes for intraday is also fairly good enough. This is for CPO. FKI, I think 30 minutes is good. Anything lower than 30 minutes, FKI, there's a certain period where it's not very active. But FKI does trend quite well compared to CPO, because CPO trends can change quite dramatically. On the morning, you can see there's one trend. The trend can reverse in the second session. So it's important. I think for CPO, anything that's 15 minutes is good for intraday, 30 minutes is good for intraday. Now, if you're looking in terms of a swing, probably more than a day, I would say an hour up to 4 hours time period chart, or even daily chart will be useful. But I think if you use 15 minutes to try to or anything that's below an hour or 4 hours, if you plan to hold a longer period, it doesn't really make much good decision, because you tend to see a lot of whipsaws along hand. So the longer time frame that you see, the appearance of a trend is actually better. But again, that depends on what kind of trader you are holding to. Are you holding on the intraday basis, or are you holding on to longer than the day? So it all depends on the individual. But I'll say this: if you are intraday, I think 15 and 30 minutes sufficient for CPO. And for FKY, 30 minutes. Anything below 30 minutes for FKY is usually get a lot of whipsaw signals. Now, if you are holding more than a day, I think an hour or 4 hours is ideal.
All right. Thank you for your advice, David. Next questions. Okay, next question. I think I will answer it. Okay, at the beginning of the sharing sessions, I saw there's a surprise price, which is a rush hour for this trading challenge. So what type of the mission can I expect in order for me to win this surprise price? Okay, I'll answer this question. Okay. So this rush hour is a special price from the main price. So in every week we'll announce 3 missions to complete, and then one mission is will be give away 30 ringgit if you hit. For example, on the first day, we announce which trader participant trading more than 30 lots of FCPO in one day. Then he is the first one to hit this target, then will win this prize. So this is one of the example. So and second day we have a new missions. You can later on you can see, and also the potential prize to win coming soon will be like most helpful traders who sharing their insights in the our Discord, the trader communities, will have chance to win this surprise prize also, and also including like the most winning traders during this the the specific time of period we set. If you have a higher winning rates, then you will win the surprise prize. Okay. Other than that, there will be like the price like multi-market activity. Okay. So if you are the traders, the first one to hit trading more than one products, then you are the multi-market activities. Yeah. So this is what is the surprise prize. Every week we're given 3, and then total there will be a 24 times. So it's about 8 weeks because the trading challenge will end at the end of June. So, okay, so just stay tuned with us and register. And the next questions, what do I need to do in order to join the challenge? Okay, so I will answer this question also. Okay, so first of all, have to open the trading account with IcebergX Securities. It's a derivative trading account, and then fund in, and then start trading. It's that simple. Okay. Next questions. Okay, next question will be on the trading parts. And David, okay, there's a participant asking, I was introduced by my friend about spread trading. Can you elaborate on how this works and how do I make money from this? And also I heard it's less volatile if compared with outright and like more safer than outright. What do you think?
Okay. There's two parts to the question. So first part, I'd like to address what is spread trading. Now, so spread trading is spread. There's many different types of spread. So I'm assuming the question asks for, if you talk about CPO, is calendar spread. So same product, but if you're trading different months. So spread involves a transaction whereby you are buying a particular month and you are doing a reverse on the, so you're selling another forward month. So why is that happen? So you are ultimately speculating on the difference between how these 2 months behave. If you recall, I think during the webinar just now I mentioned on how the forward curves behave, especially the near month trading, prices trading far above compared to the far month. So the spread, if compare the near month and the far month, is going to be wide, or say for example 50 to 100 points. Now if you are expecting, because seasonality, production coming up strongly, in the next couple of months, I show you the pattern, from April to September, October, production is going to rise, stock level is going to rise. So in coming months, prices will have to come down. So if you expect that the spread will eventually narrow, and in fact going to be a discount whereby the near month is going to be trading lower than the far month, then you will be, if you see there's a good opportunity, you'll be trying to sell a particular spread, meaning you sell the near month and buying the far month. So spread ultimately is a way for you to to speculate on the price difference between 2 different months. This is calendar spread. Now it actually boils down to a few ways. There's some people to look at things more fundamental. They're expecting that there's seasonality involved. They'll be doing a certain pair of spreads that reflect those seasonality. There's also a trend, technical trend. You can use technical strategies on spread trading as well, because spread also tend to trend in certain ways, and therefore you can also apply technical analysis on spread trading. Now, to answer the second part of the question, the audience mentioned is actually, is it safer as compared to, let's say, outright trading? Now, because of you are buying and selling, the act of buying and selling, you are expecting the differential, and you just look at the movement of a spread for a particular contract. If you compare to outright, for sure the range of spread is much smaller if you compare to outright. For example, outright per day can move in a region of 50 to 60 points difference, or even 100, but spread don't move as wide. Probably spread will move between 10 to 15 points. So in that sense, you may look at it's less volatile, and the act of buying and selling is already you are exposed to lower risk as compared to outright. So in that regard, it is actually safer in that sense. Now, but again, spread can also trend dramatically. For example, if there's a fundamental shift in a certain month, it can create a lot of movement in the spread, and eventually the spread can also be something that is very volatile. So I think that's it's an equation that if you want to understand spread, you really have to understand the dynamics on how the different months behave if you're looking at calendar spread. Now the question of being safer or not is I would say generally technically it's actually generally safer because it has a lower price volatility. But having said that, I mean I've seen spread does move quite dramatically whenever fundamentals starts to shift. So I think that's something you have to be aware of if you want to venture into spread trading, or if you're new to the spread trading itself.
I quite agree with you. I think it's not about whether it's safe or not safe. It's about how we manage the risk, right?
Yes, correct.
Okay, so I think we have a last questions. Yeah, it's also on the trading parts. And David, how should I start trading if I have 8 to 5 job?
Okay, I get this question a lot. Now, I will say this lah. As a start, if you a lot of people when because I work in a prop firm, so we get to meet a lot of people who want to join us and whatnot. So the path of being a trader is never an easy journey. And I think a lot of people say, oh, I have a passion, or I have an interest. Whether again, these are all passion interests is fine, but ultimately, is it justifiable? Because you must understand the reality of trading is very different from what many people or other people have painted outside. So I would say this: if you really want to try trading and you have a full-time job, you could try trading on a part-time basis. But keep in mind, if you really want to succeed in trading on the longer run, doing trading on a part-time basis is going to be challenging because your attention and focus is not onto trading. So like for myself and because we are part of a proprietary team, all of us are doing this full-time. And it's never easy. It's not an easy journey to start with. So it's really on an individual basis. But I would say this: if you really have an 8 to 5, you want to try trading, start it on a part-time basis, and from there, really evaluate whether trading is the path that you want to take along the way. But I think that's going to be a separate discussion. But all I can say is this: try trading as a start. Try on a part-time basis. Then from there, see where it leads you to.
All right, thank you, David. Okay, all right, and that's a wrap up of our Q&A sessions. Right, so thank you all for the great questions and engagement tonight. So before we end, let me do some summaries and tell you what will happen next. Just a very brief part. Okay. So before we end, just a quick reminder that you are not alone in this trading challenge, and we have prepared plenty of support for you. Join our Discord community, trader community, and to share thought and discuss the markets. Access our recorded webinar anytime. Book a one-to-one coaching sessions for personal guidance, and also don't miss out our upcoming webinar sessions. Yes, more insight and strategy coming your way. Just save the date and you can screenshot. Okay. Okay, and right, also as of yesterday market close, you can see in the top leaderboards who is leading the pack so far in the trading challenge. Just keep going, and it's still anyone's game. Remember, consistent is the key to successful trading. So last will be, this is our dealing support hour. Also, you can screenshot. If you have any further inquiry, you can either email to us, WhatsApp our Apex Globex contact number, and direct calling our dealing line. So morning session is 8:30 until 6, and the night time will be from 8:45 to 11:30 p.m. Yeah. All right. So let me stop sharing. Okay, so we are almost at the end of the sessions. So special thanks again to Mr. David Ng for today's valuable sharing. The trading challenge is still ongoing. So keep learning, keep trading, and make the most of this opportunity. Until the next time, stay sharp and trade smart. Thank you everyone, and good night. And thank you again, David. Bye.